The recent spike in inflation, but also the stock market wobble that went with it, have made many people think about gold as a potential hedge for those risks. So in this video, we'll look back in time at how well gold has stacked up as a hedge, but also as a source of return in your portfolio. And we'll also look at a macroeconomic model which gives a fair value for gold to see how the price stacks up right now. So let's look at the fundamental value of gold and its history as a hedge in a bit more detail. Many people say that gold is an inflation hedge, but in fact everything for which there's demand is an inflation hedge. To show you what I mean, here's the price of iron ore and copper since 1900, alongside a measure of US inflation, which is CPI. Now, while there are big deviations above and below this inflation line, on average, they've pretty much kept in line with inflation over this 120-year period. But if you think about the long term, that has to be true of everything for which there's demand. If something grows just a little bit faster than inflation for a century, then it'll just be priced out of reach of everyone. And if its price grows slightly slower than the rate of inflation, then over long periods of time the price will fall almost to zero in real terms. So if there is demand for something, then it must track inflation over the long term. So now I've added some more metals, including gold, to that long-term time series. And you can see that gold recently has been performing better than those other metals. But if we go back to the year 2000, for example, you can see that gold was actually lagging inflation up to that point in time from 1900. But this doesn't just apply to metals, it applies to anything, including food. So these are the prices of some foodstuffs in the UK since 1942. And while some have done better than inflation, for example bread and cheese, some have done worse like sugar, milk, flour and eggs. So you can bet that over the long term, any price will converge with that prices index. Now, if you did believe that, you could do a really nice trade where you'd go short cheese sandwiches, which are above that RPI line, and at the same time you'd go long cake. But my serious point here is that gold is not a particularly good inflation hedge. You could say the same thing of other industrial metals or even cheese sandwiches. Now, many people say gold has outperformed equity over a long period of time, so let's see how well those claims stack up. Now, the total return of any investment has two components. The first one is the income it generates, and the second one is a capital gain, when you buy at a low price and you sell at a higher price. Now, in the case of gold, unlike a dividend-paying stock or a bond, it doesn't generate an income. So the total return of gold only consists of capital gain. And if we look at the history of the price of gold over a century, you can see it breaks up clearly into certain regions. So this big flat region, which you can see going up to about 1970, was during the gold standard. Now, the price of $1 was fixed relative to the price of gold, so there wasn't really a price of gold during this period. Then after the gold standard ended, we got the first of three mega rallies in gold at the end of the 1970s. But the problem with buying into one of these rallies in gold is that it turns around very quickly and usually corrects back down to fairly low levels. So for example, after that spike in the 1970s, you can see that there was a 20-year period when gold basically did nothing. Then we got the second mega rally between the year 2000 and 2011, and again a period of retracement which lasted many years. Then we had a more recent rally in gold in 2019, but that does seem to have turned around. But if we're thinking about gold over the long term, we also have to consider the rate of inflation. So if we adjust the price of gold using US inflation, what you can see is a very different picture. That spike which we saw in the price of gold, which peaked in the early 1980s, looks even more impressive. But since then, gold has done a very poor job of keeping up with inflation. That's why we see a big sag over that 20-year underperforming period. Now, if we look at the drawdown of gold relative to its previous all-time high, we get this blue line. Now, because this is the percentage fall relative to the most recent all-time high, when it's at zero, that means it's pushing new highs. So between 1974 and 1979, there was a 4-year period when gold didn't reach its previous all-time peak. But what's pretty shocking is that gold is currently in the midst of a 42-year drawdown. When we adjust for inflation, gold hasn't regained its peak from 1980. In fact, its current price is 40% below that peak. In fact, if we look back in time to see when gold was at its current price when we do adjust for inflation, it was hovering around current prices in 2011, but of course it was also around current prices around 1980. So by not paying an income which increases the total return, gold pays this penalty of being a wasting asset. And that's one of the reasons why equity has outperformed gold, because not only has it given great capital gains, but it's also given a steady source of income in the form of dividends. And if we compare gold, the S&P 500 and US 10-year Treasuries in terms of real return, you can see that gold is a relatively high risk investment. And for the extra risk you take for holding gold, it hasn't really paid off in terms of extra return. Whereas equity, which is intermediate between Treasuries and gold in terms of risk, has given you much better returns for every unit of risk that you've taken, as measured by volatility. Of the three assets, Treasuries have given you the lowest return, but that's also come with a much lower risk. So as a day-to-day hedge, you probably don't want to introduce something into your portfolio which actually adds to the risk during normal market conditions. And that's one of the reasons why I think Treasuries would be a better long-term hedge of equity than gold. Now, if you are investing for the long term, the difficulty with a hedge is that it forms a drag on your return. So if we simply look at the real return of those three assets, you can see the cost of holding a hedge. Now, gold on average since 1971 has returned 3.9% above inflation, but that's really not much more than Treasuries, which have returned 3.1%. But either of these hedges will form a long-term drag on return. So if you are investing for decades, you really have to question whether it's worth holding these hedges at all. Now, there are certain factors which have fairly consistently driven the price of gold historically. So we've built a very simple fair value model for the price of gold. The model has three drivers, the first of which is inflation, because as we saw previously, the price of gold, like every other price, does go up with inflation over time. The second driver is interest rates, which has a negative effect on gold. To understand why this is true intuitively, imagine that Treasuries were giving you a 10% return. Well, for an asset which has very low volatility, backed by the government, then you'd much prefer something which gives you an income over something which doesn't. So by being a wasting asset, gold becomes much less attractive when a risk-free asset like US Treasuries is paying you something like a 10% yield. So as yields increase, gold becomes relatively less attractive. So it has this negative relationship with interest rates. Now, like any commodity, gold is priced in US dollars. So if the value of the dollar strengthens, that actually weakens the price of gold. And one way to value the strength of the US dollar is versus a basket of the US's trading partners. Now, if you enjoy our videos and you want to learn more about investing and support us, a great way to do that is by joining our Patreon community. To learn more about that, just click on the link beside me and in the description beneath me. So the graph you can see here is the output of our very simple gold fair value model, which our Patreon supporters get full access to. So the blue line is the actual price of gold since 2004, and the red line is the model's fair value. And you can see that fair value and the actual value of gold have been pretty close together in the past. Although there have been periods when there is a discrepancy, these tend to be fairly short-lived. But what's really notable is this divergence that we started to see as gold peaked in August 2020. So the orange line here is the value of gold, and the blue line is the value of a US Treasury ETF. Notice that as yields were falling, the value of the Treasury ETF gradually increased, as did the value of gold. And then as people grew more concerned about inflation, yields on bonds rose, the price of bonds fell, and so did the price of gold. But as we saw from the model, the price of gold has fallen more than you'd expect from the yield increase that we've seen. But based on this very simple approach to fair value for gold, at the moment it looks as if gold is very undervalued. Now let's turn to the value of gold as a hedge for equity. Now, if you're trying to hedge equity prices, what you don't want is an asset that moves up and down in lockstep with that asset. So if that's the case, then the correlation of those two assets would be 1. Ideally, in a hedge, you'd want something which has a negative correlation because the moves tend to cancel one another out. So what I've got in the graph above me is the correlation of the S&P 500 with gold over time. Notice how it's not stable. It tends to fluctuate between positive correlation in blue and negative correlation in red. So this is another reason why I don't like gold as an equity hedge. It simply doesn't have a stable negative correlation or zero correlation with the S&P 500. In contrast, if we look at the correlation of the S&P 500 with US Treasuries, there's a consistent negative correlation. You can see that the line beneath me is red most of the time to show that the correlation's negative. Now there are some interesting exceptions. For example, look at 2012 and 2013 when the correlation went positive. This was at the time of the taper tantrum when people were worried that the Fed would slow down its rate of asset purchases, just as they're worried now. In that situation, the price of treasuries falls at the same time as equity prices falling. So in response to taper tantrum fears, gold is probably a better hedge than treasuries. Another example is with the debt ceiling, which we're also seeing at the moment. There you'd also expect treasury prices to fall, and because people are scared, equity prices would fall at the same time. And again here, you'd expect gold to be better than treasuries. But when you don't get those two special circumstances, you can see that most of the time, treasuries are a better equity hedge than gold. But when we're thinking about a hedge, the scenario we're concerned about most of all is when you get a deep and protracted fall in equity prices. So what I've done here is to show that drawdown graph, but for the S&P 500. And if we look back to the 1950s, two periods really stand out as being deep and protracted bear markets for equity. The first one chronologically was a 12-year period between 1973 and 1985. And during that period, equity markets fell by about 50%. And the second period started in 2000 with the dot-com bubble bursting. Then just as that was about to recover, we got a second dip due to the global financial crisis, such that the entire double dip period was about 13 years. And again, the depth of the fall was over 50%. So what we're going to look at now is how well those two hedges, gold and treasuries, performed during those drawdown periods. In the top two panels of this graph, we've got the drawdown of the S&P as this blue shaded region. And in this uppermost of those two panels, you can see the cumulative return of gold through those drawdown periods. Now, if you'd have bought gold just at the beginning of the drawdown, at its peak, the cumulative return on gold would have been 500%. So that was certainly a brilliant hedge during that period. And in this bottom panel, the shaded red region is the Fed's policy rate, which you can see reached incredibly high levels in the early 80s as the Fed was trying to stave off very high inflation. And that's the blue line. And inflation, as you can see, peaked at almost 15% in 1980. Now, treasuries were an atrocious hedge through this period because they had two things which worked against them. The first problem was that inflation was very high during this period, and inflation's like kryptonite for treasuries. And at the same time, during much of this period, the Federal Reserve was raising interest rates. And again, that's going to be a bad story for bonds because as rates rise, their prices fall. So the Volcker period, as this is called, was certainly a huge fail for treasuries as a hedge for equity. The second big drawdown period, the one which started in 2000 and ended in 2013, was very different. This time around, gold was also a very good hedge, so it rose by about 400% through this period. But what was different this time is treasuries also acted as a good hedge. So they rose by almost 75%. But to see why treasuries did well, you only have to look at what the Federal Reserve was doing at the time. Most of the time during this period, interest rates were low and they were being cut by the Fed. And at the same time, inflation was very well contained. It only rose above 5% very briefly. So putting all of this evidence together, how do you go about choosing a hedge for your portfolio? To answer that question, you've got to look at the drivers of those two assets, and you've got to have a view as to what's going to happen to those drivers. Now, the primary difference between the drivers of gold and treasuries is their response to inflation. We've already seen that gold is a lousy inflation hedge, but just like every other asset for which there's demand, it's going to increase in value alongside inflation. Whereas for treasuries, inflation is particularly toxic. So inflation would tend to drive up the value of gold, or at least not change it much, whereas treasuries will almost certainly lose value if inflation spikes. The second factor which drives both of these assets is the level of interest rates. As interest rates rise, both gold and treasury prices are driven down. But the difference is that with treasuries, as time goes on after the initial loss, and as the treasuries inside a fund are sold and new ones replace them, those new bonds will have a higher coupon. So the income income on Treasury funds will gradually rise with this new level of interest rates. Whereas with gold, the value will gradually be eroded the longer interest rates remain high for risk-free assets like Treasuries. The final factor which drives the prices of both of these hedges in the same direction, upwards, is fear. Because when people are scared, they buy safe haven investments like gold and Treasuries. But as we've seen, the nature of the fear is important. So for example, if it's fear of a taper tantrum or fear of a debt ceiling being hit, then gold would be better than Treasuries. But if the source of the fear is neither of those two special cases, then gold or Treasuries would both be a good safe haven investment. So if you have convinced yourself that we're going to get a deep and protracted crash in equity, then it's worth thinking about a hedge. But it's also important to think about what's going to happen to inflation. If it is high during that crash period, and maybe even triggered by high inflation, then gold would be the better hedge. Now remember, you can always help us by liking this video, just click on the thumbs up, or subscribing to our channel. That way you won't miss any of our new content. And, as always, thank you for listening.